The General Portfolio Policy, the Defensive Investor by Benjamin Graham. The basic characteristic of investor portfolio is usually determined by the position characteristic of the co-owners and owners. At one extreme, we have had a saving banks, life insurance companies, or so-called legal trust funds. A generation ago, their investments were limited by the laws in many states and high-grade bonds and some case high-grade preference stocks. At the extreme, we have well-to-do and experienced businessmen who include any kind of bonds and stocks on the and security list provide he consider it an attractive purchase. It has been old and sound principle that those who cannot afford to take a risk should be content with a relative low return on their investment funds. For this, there has been developed a general notion that as a rate of return which is investor should aim for more or less proportionate to the degree of risk that is ready to return. Our view is different. The rate of return should be dependent rather on the amount of intelligent effort of investors willing and able to bring to bear on the task. The minimum return goes to our passive investor who wants both safety and freedom from concern. The maximum return would be realized by the allowed enterprises investors who exercise maximum intelligence and skills. In 1965 and added in many ways is there may be less real associated with the buying and bargain issue, offer a chance of large profit than the conventional bond purchase yielding 4.5%. A statement that more than true that is we also expected since the subsequent years even the best long-term bond lost a substantial part of the market value because of the risk of interest rate. Basic problem of stock allocation. We have already outlined the briefest form of portfolio policy of defensive investor. He should divide the funds between high grade bonds and high grade common stocks. We have suggested as a fundamental guiding rule that investor should never have less than 25% or more than 25% of fund in common stocks, with consequent inverse range between 75% 25% in bonds. There is an implication here the standard division should be equal to 50-50 between the two major investment medium. According to the tradition, a sound reason of increasing percentage of common stocks would be appearance of bargain price, a level created in protecting bear market. Conversely, sound produce call would call reduce the common stock common below 50% of the judgment of investor. The market level has become dangerously high. The copybook maximus have always been easy to enunciate and always difficult to follow because they go against that every human nature which is produce excess of bulls and bear market. It is almost in contradiction in the terms of suggestion the feasible policy of average stock market that lighten the holding when the market advance beyond certain points and to them add to them after a corresponding decline. It is because the average man operates and average one apparently must operate in opposite fashion that we have had the greatest advantages collapses in the past and which writer believes we are likely to have them in future. If a division between investor and the speculative operators were clear now as once was and might able to envisage investor as a shared experience grow which wholesales out the hapless speculators of high prices and buyback of depressed levels. The pictures may have been very simulate bygone days. But on the hard indeed is financial development since 1914. There is no indication that professional operations as those of mutual funds has been conducted in the patients. The percentage of the portfolio held equals to two major types of funds, balanced and common stocks. A change varying little from year to year. The selling activities has been largely related to endeavors to switch from less to more promise holding. If as we have been believed the stock market has lost contact with the old bonds and the new ones has yet not been estimated, then we can give an investor no realizable route by which to reduce the common stock holding to 25% minimum and rebuild them later by 75% maximum. We can urge that general investor should not have more than one half of the equity unless he has a strong confidence in the soundness of the stock position and ensure that he should view the market declined in 1969 70 types of equanimity. It is hard to it's hard for us to see how much strong confidence can be justified as less existence of early 1970s. This we should conceal against greater than 50% appropriate to common stocks in the same. But for the complementary reason, it is almost equally difficult to advise a reduction in figures well below 40% unless the investor is qualified in their own mind about the current market and well be satisfied until they limit the participation in the further rise to and say for 25% of total funds. We are thus led to put forward most of the readers that we may appears to be oversimplified 50-50 formula under the plan of guiding rules of maintaining the nearly practitioner equal division between bonds and stock markets. When the changes in the equal market value has arisen, the common stock component say 50% of the balance would be restored by a sale of 1/11th of the stock portfolio. The transfer of the proceedings to bonds. Conversely, a fall into the common stock proportion to 45% will call off a 1/11th of the bond fund to buy additional qualities. Yale University followed a somewhat similar plan to number of years in 1937. It was geared about 35% of normal holding is common stock in the early 1950s. However, the Yale seems to have given up its one of the famous formula in 1969. It held 61% of the portfolio in equity, including some convertibles. At the time, the endowment fund was a 20% of asset invested in total is 7.6 billion or 60.3% of common stocks. The Yale example illustrates almost a lethal effect of great market advance upon once popular formula approach to investment. Nothing less, we are convinced that 50-50 version of the approach makes good sense for the defensive investor. It is extremely simple. It's aimed unquestionably in the right direction. It gives a follower the feel that he is at the least making more moves in response to market development. Most important of all, it is will sustain him from being drawn more and more heavily into the common stocks as a market rises to more and more dangerous heights. Furthermore, a truly conservative investor will be satisfied with the gain shown on half of the portfolio and the rising market, while the severe decline he may derive much solace from the reflective how much better off that he that may be more venture funds. While our proposed 50-50 division is undoubtedly simple as all purpose programs, the divisible it must not turn out in the best terms of result achieved. Our course no approach mechanical otherwise can be advanced with any assurance with that will work out better than others. The much larger income return now offered by good bonds that the representative stock is potent argument for favoring the bond component. The investor choice between 50% of low or the lower figures of stock may well rest mainly on the own temperament attitude. If he can act on the cold-blooded waiter of the odds, he may like to favor to low 25% of stock component at the time. This idea of waiting until DGI dividend yields was he two-thirds of the bond yield before the establishment meeting of 50-50 division between the bonds and stocks starting from 900 from DJI invest dividend on $36. This would require either the fall in taxable yield bonds from 7.5% to 5.5% without any change in the present rate of lending stocks, or a fall in the DJIA to as low as 660 if there isn't no reduction in the bond yield and no increase in dividend. A combination of intermediate changes would produce the same the buying point. The program of this kind is not especially complicated. The hard part is to adopt it and stick to it. It's not a mention of possibility that is may return out and leaves much as too conservative. The bond component. The choice to issue the bond component of the investor portfolio will turn out two main questions. Should he buy taxable and tax-free bonds, and should he buy shorter or long-term maturities? Tax decision should be mainly matter of arithmetic, turning out the difference in yield and compared with the investor's tax bracket. In January 1970, a choice of 20 years maturity was between obtaining, say, 7.5% grade A corporate bonds or 5.3 prime tax-free issues. The term municipals is generally applied to all the spaces of tax-exempt bond, including state obligations. There, thus, a maturity, a loss in an income of some 30% is pausing from the corporate to municipal field. Hence, the investor who has a maximum tax bracket higher than 30%, he would have a net savings after tax by choosing the mutual bonds of option.
If a maximum tax are less than 30%, single person starts paying 30% of a rate when his income after deduction passes $10,000. Is a married couple, then the rate applies when the combined tax income passes $20,000. It is evidence that a large proportion of the individual investor will obtain a higher return after taxes of good municipals than of good corporate bonds. Choice of a longer versus shorter maturities involves quite a different questions. That is, does the investor want to assume himself against a decline in the practice on by price of bonds? Does the investor want to assume himself against a decline in price of bonds but the cost lower annual yield? Second, loss of possibility of appreciable gain in principal value. We think the best of the discuss the question investors and market fluctuation. For the period of many years in the past, only sensible bond purchase for individual, the US savings issue, that the safety was unquestionable. They gave a return, they have a higher return than other bond investors and the high quality. But they have a money back option and other privileges were added generally to its attractive. In our early editions, we have the entire chapter in the US savings bond, a boon to investors. And we shall point to US savings bonds that possess certain unique merits that make them a suitable purchase by an individual investor for a man of modest capital. With say no more than $10,000 to put into bonds, we think that it's still a easier and best choice. But these with the lesser fund may find about median and more desirable. Let us list a few major types of bonds that deserve investor consideration and discuss them briefly with respect of general description. Safety yield, mid-mark safety yield, market price, risk, income tax status, and other features. One, the US savings bonds, Series E and Series H. We shall first summarize the important provisions that discuss briefly in the numerous advantages of the unique, attractive, and exceedingly convenient investments. The Series H bonds pays interest semi-annually, and as do other bonds, the rate is 4.29% the first year, and the flat 5.10 in the next years to maturity. Interest on the Series E bond is not paid out, but the accrue to holders through increasing redemption value. The bonds are sold at 75% of the face value, maturity at 100%, and in 5 years and 5 years 10 months after purchase, if held to maturity, the yields works out to 5%, compounded semi-annually. If redemptions early, the yield moves from the minimum of 4.01% first year to the average 5.2%, next 4.56% the 5 year. Interest on the bond subject to the federal income tax, but it is exempt from state income tax. However, federal income tax is on Series E bonds may be paid to the holder option either annually as an interest accrued to the higher redemption value or not until the bond is actually disposed of. Owner of Series E bonds may cash them. The owner of the Series E bond can cash them in any time shortly after purchase on the current redemption value. Holders of Series H bond have similar rights to cash them at a par value. Series E bonds are exchangeable for Series H bonds with certain tax advantages. The bonds lost, destroyed, and stolen may be replaced without cost as a limitation on annual purchase, but a liberal provisions of co-ownership of family members make it possible for most investors to buy as many as they can afford. Comment: there are no other investment than market campaigns, absolute assurance of principal interest payment, the right to demand full money back at time, and guarantee of at least 5% interest rate at least 10 months. Holders of the earliest issue of Series E bonds have had a right to extend their bonds at maturity and thus to continue to accumulate annual values and successive higher rates. A deferral income tax payment over the long periods has been great dollar advantages. We calculate it was increasing the effective net after tax rate that is we buy and such a third and typical cases. Conversely, the right to cash as a bonds, the cost price is better than giving purchase for many years of lower interest rates. Complete protection against the shrinkage of principal value that befell many bond investors. However, otherwise stating, it gave them a possibility of benefiting from the rising in interest rates by switching from the lower interest rate holders. in every home, any high coupon issues are the even money basis. In our view, the special advantages enjoyed by the owners of savings bonds now will more than compensate for their lower current return as compared with the direct government obligations. Other United States bond, presumed these issue exists, covers a wide variety of coupon rate and maturity rates. All the them are completely safe with the respect of payment of interest and principal. They're safe. They are subject to federal income taxes and tax, but free from the state of income tax. In 1971, the long-term issues over 10 years shown average yield of 6.09%. Intermediate issues 3 to 5 years returned 3.35%. And the short issues are 6.03%. In 1970, it is possible to buy number of old issues at the large discount. Some of them so accepted a par in settlement of estate taxes. Example, the US Treasury of 3.5% due to 1990 as the category. They sold at 60 in 1970 but closed in 1970 above 77. It is interesting to note also in many cases the indirect obligation of US government yield appreciably more than the direct obligations of the same maturity. As we write, an offering appears in 7.05% of certificate fully guaranteed by the Secretary of Transportation of Department of Transportation of United States. The yield was fully 1% more than the direct obligation of US maturity same year 1986. The certificate were actually issued in the name of the trustees of Penn Central Transportation Co., but they were sold on the basis of a statement of U.S. Attorney General that are guaranteeing bring into being general obligation of United States, backed it fully faith and credit. Quite number of indirect obligations of its sort has been assumed by the U.S. government in the past, and all of them has been scrupulously honored. The readers may wonder why all this hoco opus involved in apparently personal guaranteed by a Secretary of Transportation and higher cost to the taxpayer in the end. The chief reason is an indirection has been a debt limit imposed on the government borrowing by the Congress. Apparently guaranteed by the government is not regarded as a debt. The semantic windfall of the Schwerder investor, perhaps the chief impact of situation, has been created by tax-free housing authority bonds, enjoying equivalent of U.S. guarantee and virtually only tax-exempt issues that are equivalent to government bonds. Another type of government-backed issue is recently created by a new community debenture offered by yield 7.60 in September 1971. The state and the municipal bonds these enjoys exempt from the federal income tax. They are also ordinarily free of income tax in the state of issue, but not elsewhere. They are either directly obligation to state or subdivision or revenue bonds. Department of the interest payment of a receipt from all the toll roads, receipts from bridges, building lease, etc. Not all the tax-free bonds are strongly enough protect to justify their purchase by defective investors. He may be guided to the election of a rating given to each issue of Moti or Standard or Poor. One of the three highest rated of both services, AAA, AA, and A, should be constituent of sufficient indicator of adequate safety. The yields of the bonds will vary both in the quality and maturity, with the shorter maturity gives a lower return. In 1971, the issue representing a Standard and Poor municipal bonds index average AA is quality rating and 20 years in maturity, 5.78% of yield. A typical offering of a Wineland NJ bonds rated AA gives a yield of 3% on the 1 year maturity and rising to 5.8 to the 1995-1996 maturities. The corporation bond. This bond is subject to both federal and state tax. In the early 1972, those high quality yield 7.19% of 25-year maturity. He reflected the published year of Moody AAA corporate bonds index. This is called the lower median grade issue. Based BAA return 8.23%, a long maturity. In this case, the short-term issue would yield somewhat less than the longer-term obligations. Comment: the above summaries indicate that the average investor has several choices among high-grade bonds. The high income tax brackets can undoubtedly obtain a better net yield from the good tax-free issues than from the taxable ones. For the other than 1972 range, taxable yield would seem to be 5% on US savings bond with the special option to about 7.5% high grade corporate issues. Higher yield bond investment. By sacrificing the quality of investors can obtain a higher income return from the bond. The long experience has demonstrated that the ordinarily investor is wiser to keep away from the high yield bonds. While taking on the whole, they may work out somewhat better in terms of overall return than the first quality issues. They exposes the owner to too many individual risk of untoward developments ranging from disquietness, price declines to actual defaults. It is true that bargain opportunity occurs fairly often low grade bonds, but they require special due study and skill to exploit successfully. Perhaps we should add that there is a limit imposed by the Congress on the direct bond issue of the United States, having produced at least two sorts of bargain opportunity for investors in purchase of the government-backed obligation. One provided by the tax exempt new housing is issued as the other is a recently creation taxable new community debentures. An offering of new housing issued in July 1971 yields a higher of 5.8% free from both federal and state tax, while the issue of taxable new community debentures sold in September 1971 yields 7.6%. Both the obligations have full faith and credit United States government behind them and hence safe without questions. And on the net basis, they yield considerable more than ordinary United States bonds savings deposit in lieu of bonds. An investor may now obtain higher an interest rate in a savings bond in the commercial savings bank or for the bank certificate of deposit as he can from a first grade bonds or short maturity. The interest rate on the saving bond bank savings accounts may be lower in the future, but under the present conditions they are suitable substitute for short term bonds investment for the individual. Convertible issues. There is a discuss in chapter 16. The price variability of bond is generally treated and the investor and market fluctuation. Call provision. In previous edition, we have fairly long discussion on the aspect of bond financing and becoming involved in serious but a little noticed injustice to the investors. It is typical case of bonds were callable fairly soon after issuance and modest premium say 5% above the issue price. This meant that during the period of widely fluctuation in underlying interest rate, the investor had to bear the full burden of unfavorable changes and was deprived of all the merging participation favorable ones. Example, our standard example has been issue of American Gas Electronic 100 years 5% debentures sold to the public at 101 in 1928, and 4 years later under near panic condition the price of this gold bonds fell 62.5% yielding 8%. By 1946, the Great Reversal bonds, this type could be sold to yield only 3%, and the 5% issued have been quoted to close to 160. But at the point, the company took advantage of the call provision and redeemed the issue merely at 106. The call feature in this bond contract was thing discussed instance heads I win, tails you lose. At long last, the bond buying institute refused to accept the unfair agreement to recent use. Most long-term high coupon is issued have been protected against redemption of 10 years and more than issues. This still limiting the possibility of possible price rise, but not inadequately. In practical terms, we advise the investors in long-term issue to sacrifice a small amount of yield to obtain assurance of non-callability, says for 20 to 25 years. Similarly, there is an advantage in buying a low coupon bond at discount rate rather than high coupon bond selling at par and callable for a few years. For the discount in the top 3.5% bond and 63.5% yielding and 7.85% carries full protection against adverse call option. Straight debtors, non-convertible preferred stocks. Certain general observation should be kept here subject to the preference stocks. Really good preferred stocks can and do exist, but they are good in spite of the investment form, which are inherently bad one. The typical preferred shareholders depend from the safety on the ability and desire the company to pay dividend on a common stock. Once a common dividends are omitted, even in danger, his own position becomes precarious for the directors and under no obligation to continue paying him unless they also pay on the common. On the other hand, the typical preferred stocks carries no shares in the company's profit beyond the fixed dividend rate. Thus, a preference holders lack both a legal claim of the bondholder or a creditors and the profit possibility of common shareholders or partner. These weaknesses, the legal positions of preferred stocks, tends to come to the fore recurrently in the period of depression. Only a small percentage all preferred issues are so strongly entrusted as to maintain an unquestionable investment stature through all viscosity. The experience teaches that the time to buy preferred stock is when the price is unduly depressed by temporary adversity. At such times, they may be well suited to aggravate investor but too unconventional for the defensive investor. Other words, they should be bought on the bargaining basis, not at all. Or not at all. We shall refer later on the convertible and similar privileged issues, here, which carry some special possibilities of profit. They are not ordinarily selected for conservative portfolio. Another peculiarity is group gentle provision of preferred stock deserved mention. They have better tax status for corporate buyers than the individual investors. Corporation pay taxes around 50% of income they are receiving dividend, but on the full amount they are ordinary interest income. Since 1972, corporate is 48%, means that $100 received on a preference stock dividend is taxed to $7.2, where $100 received on a bond interest is $48. On the other hand, the individual investor pay exactly the same tax on preference stock investment as the bond interest, except for the reason minor exception. There's a strict logic of all investment grade preference stock should be bought by the corporation, just as all tax exempt bonds should be bought by the investor who pay such tax, which income tax. Security form, bond forms and the preferred stocks. The bond from and the perfect preferred stock form is hitherto discussion as well as understood and relatively simple manner. A bondholder is entitled to receive fixed interest and payments and principal on defined date. The owner of the preferred stock is entitled to fixed dividend and no more, which means pay before come dividend. The principal value doesn't come due on the specified date. Dividend may be cumulative or non-cumulative. He may or may not have a vote. The above description, the standard, provided no further the majority of bonds or preferred issue, but there is an innumerable departures on the forms. The best known types of convertible and similar issues and kind of bonds in the later type, and the interest does not have to be paid unless it is earned by the company. Unpaid interest can accumulate as a charge against future earning, but the period is often limited to 3 years. Income bond should be used for corporations much more extensive than they are. The available apparently rises from the available avoidance apparently arises from the mere accident of economic history, and namely they have been firstly employed in the quantity of connections and railroad and reorganization, and hence they has been associated from the start with the financial weakness and poor investment stature. But the form itself has several practical advantages, especially in comparison with the substitution of numerous preferred issues, stock issues in recent years. Chief of this is a deductible of interest paid from the company taxable income, which is the effect cuts the cost and forms the capital in half. From the investor standpoint, it's probably best for him in most cases that he should be an unconditional right to receive interest payments when they are owned by the company. In other forms, a protection that the bankruptcy proceeding of if interest is not earned and paid. The terms of income bonds can be tailored to advantage of both the borrowers and the lender in the manner best suited for. Conversion privilege can of course include the acceptance of everyone as inherently weak preferred stocks from the rejection of the stronger income bond from the fascinatingly illusion of a way in which traditional institutional habits often tend to persist on the Wall Street despite new conditions calling for a fresh point of view. With a very new wave of optimism and pessimism, we are ready to abandon history and time tested principle, but we clinging tediously and unquestionable of our prejudice. Comments by Jason Chewing. Not being able to rule events, I rule myself and adopt myself to them if they do not adopt themselves to me. Michael D. Montague.
As the hardest part of being defensive investor is defending yourself from yourself. Most conversion investor wisdom focus on what to do. Intelligent investor focus most of this energy on what not to be doing. What not to be doing. This is not a test. How much risk should we take? The conventional answer depends on what financial advisors can your risk tolerate. A nebulous concept they often measure by asking you a few of a half dozen questions, including this nonsensical favorite. If an stock market drop 20%, would you sell or hold or buy more? When the markets are calm, it is easy to use say buy more in the market crash. But the same way you might say this goes, you would rush into the burning building to rescue people inside. However, saying you will run into a burning building is a lot easier than running into a burning building, and asking you will buy stocks in the market crash is a lot easier than doing it. The market crash is not a quiz. When every stock market is blazing blended on your phone, the headlines are apocalyptic and market punch and shrink it on television that you should sell everything before it's too late, and your family is begging you to stop throwing money into flames and buying more. It's in the act of bravoda. It is terrifying. But tolerance over risk don't stay constantly most of your life. It might not even stay constant from heart to heart. And that's why the Graham warns against picking your portfolio based on how much risk you on a financial advisor thinks you on stomach. Your risk tolerance is out of control. Economists and psychologists have shown that how much financial risk you are willing to take at your moment depend on how well the stock market has done lately, how well your own investment has done lately, whether you are investing alone or part of a group, whether you are feeling happy or anger or sad, anxious, or fearful or disgusting, how much money you had between age 18 to 25 of your country, which country and culture you come from, whether stock price end of the digest digit, whether stock price end in the digit 4, 8 or 9, whether you got the money you are investing, what time of year is it, what time of day is it, how well you slept, how long you last it, whether the sun is shining, how recently you read about airplane crashes, whether your favorite sport team won or lost in a big game. These are just a few of the factors that have been identified. They're all the reminder that without politics and procedures to guide you, you will be at the mercy of the market's ever changing moods and your own. Yeah, LKU Weber and Justin Kleeman risk tolerance and circumstances. Defensive virtuous enterprises. Based upon the faulty assumption that people's risk tolerance is stable, financial advisors often offer conservative, moderate, and aggressive portfolios whose riskness is defined by their exposures to stocks. The conservative portfolio might have not more than 40% of stocks on moderately allocation. 60% are aggregate basket and 80% are more. Graham thinks that it is an ludicrous when the stock market shows conservative investors forget forget they even wanted protection against loss. They became consumed with energy ever the gain they would have owned if only they had more than that. They measure 40% of stocks desperately to make up the lost time. Sick of listening to other people brag about getting rich, they buy stock urgently and right before a crash. After a market crashes aggressively, investors forgot their original goals of making as much money as possible. Reeling from the wreckage of the wealth, they flee stocks and rush into safety of cash. Brave as a lion when stocks were expensive, they morph into mice when stocks became cheap. Instead of using phony notions about a risk tolerance, Graham draws a different distinction. How much risk you should take depends on how much time and amount of intelligent efforts you are willing and able to put into investing. If you are too busy to don't feel qualified to put as much more time and effort than it takes to read this book, Then Graham want you to consider yourself defensive investor. That means you don't have to bother working hard at all. That doesn't mean being a defensive investor is easy. You will need to master the discipline to follow an investment policy statement. And you also must accept the bull markets and will leave you behind. Someone you know will always be making you more money than you, and above all of this you don't know and you don't care what is financial markets are going to do. But you shouldn't feel no shame whatsoever in deciding you are a defective investor. Isn't then confession of weakness and abdication of responsibilities or admission that you aren't smart or skilled? It's simple to recognize that incurring higher fees and costs in pursuit of superior returns and waste of money unless you can also commit the time and effort to take to be an entrepreneur investor. On the other hand, if you are enjoying studying business and analyzing financial statement, then you are probably or an enterprising investor. You too will need to formal investment policy, and you will have to invest not only on your money but also a lot of your time and energy. First you will have to probe deeply into an investment before you make it, and so long you continue to own it, you will have to analyze yourself even more deeply, creating a continuous learning environment that will enable you to identify your mistakes and benefits from feedback and develop and follow consistent rules. The beauty of Graham distinction between defensive and enterprise investor is that unlike your purported risk tolerance isn't prone to change just because the markets make a big move up and down. Defensive investor is much like a conservative investor to suffer a fear of missing out when the stock soar. An enterprise investor is how much likely aggravative one or remain disciplined when stocks scramble. Better question. Here are some questions that will help you to get a honest answer about how much money you should have in stocks. What is the circumstances prefer? What are the circumstances, preference and objectives? Age, marital status, income earning potential of spouse and partner, expected job security. Do I own, rent, a plan to buy a home? Do I or will I have a children and tuition to pay? Will I inherit money or will I need to provide for my parents? How ample is my employer sponsor a retirement plan? How reliant am I and my investment to produce regular income? How much physical capital do I have? How can I make my human capital grow? What I do during my past down markets? The best guide to how you will behave in the next crash is how you behave in the last one. We all tend to rewrite our own history, making ourselves braver in memory that were in reality. If you recall the financial crisis 2009, you may well believe you bought more stocks when in fact you sold or froze. You might also feel you bought more during the COVID crash 2020 when you are in a real time too scared to do anything. Dig up your old account statement. If you sold or sat on the hands of past crashes, you probably will be the next one. Don't raise your stock exposure now above where it is then. How flexible is my goals? Ability to withstand a risk depends partially on how much money you can have and can earn, but also how much control you have over the timing of future spending. If you can't afford buying an expensive house or a children must attend private school, your capacity of taking risk is more limited than your cash balance might imply. Always have enough cash to cover at least 6 or 12 months of your spending needs and will improve your flexibility. How well do I understand the risk of the rest of the portfolio? My financial advisors have talked this client into assets like emerging market debts, bank loan funds, and non-trading real estate. In the crisis, these income-producing but risky investments may go down at least much as U.S. stocks. The long-term bonds, even U.S. Treasuries, will suffer steep losses in interest rate risk. Trendy holdings such as private equity ventures, capital hedging funds, and other alternative assets can be difficult to sell if you need to cash in a hurry. If such investment has some supplement cash and short-term to medium-term government bond in your portfolio, you are less able to withstand a stock crash than you think. Have I turned rules into habit? If human nature is belief, then times are calm that you will do a right thing in the heat of moment. In the market crash, however, willpower is worthless. You can stay calm only if you have practiced beneficial rules until they become good habits. If you check the value of your portfolio multiple times a day during a bull market, you have formed a toxic habit and you would kidding yourself if you think you won't freak out and sell during the bear market. ABC of IPS. The investment policy statement (IPS) is a formal document that spells out your investing circumstances, preferences, and goal. It explains how you plan to achieve your objectives and make significant decisions and measure your progress. Also serves as a constant reminder of what you are committing not to do. Every IPS, like every investor, is unique. You should customize the following generic template of your own need and circumstances, changing it as much as necessary. Start with the mission statement. The primary objective of the portfolio is to long-term growth with an ultimate horizon of years to help fund the coming decades expenses of yourself, for your children, and for the grandchildren. We will pursue this goal with the patience and perseverance. Prudence, taking no unnecessary risk and never seeking of maximum short-term return. And secondary objective, you will be provide regular income. The primary decision makers will be dash and dash. Spell your structure. The portfolio will be broadly diversified based upon the careful review of your objectives and constraints and reasonable and expectations of returns of a following assets. It will allocate percentage to cash, percentage to bond, percentage to US stocks, percentage to international stocks, percentage to public real estate, and percentage to others. So your allocation will be broadly distinctified with a minimum of dash underlying holding. We will never use margin or other borrowing money. I will maintain enough cash to cover at least 6 months of expenses. The description implications, we will be bolster our patience by rebalancing times per year and dollar cost average. We will select mutual funds, ETF, and other investment by the lowest cost, not by the highest return. The total annual expenses, including all fees and trading costs, must be not exceed 1%. We will never buy any assets one the total highest return. Total annual expenses, including all the fees and trading costs, must not exceed 1%. We will never buy any asset only because its price has gone up, or sell only because its price has gone down. All purchases and sales must fully conform to criteria of our checklist, which must be filled out before our trade. If you have a mad money account, it will be funded with no more than 5% of financial capital and will be segregated to at a separate financial institution for the rest of our asset. Under no circumstances, the other either gain or loss can we add more money to it. Final discussion monitoring. We will update the value of all the holding not more than 4 times a year. We will measure performance relative to the dash benchmark, evaluating multi-layer return first and recent return last. Over a year, we will review the IPS to consider whether our circumstances before an objective have changed. Any departure from IPS must be justified in writing and agreed to by everyone who is party. I have often suggested, only half joking, that investors should keep and print an original of their IPOs, one of their red emergency boxes label in case of fire, break a glass. If you can't rewrite your detail in the document unless you first smash open its glass case with a hammer, you will hesitate before impulse you changing in suck next time of market goes down. Passive or active. If if you are a defensive investor, you shouldn't bother picking specific stocks or attempting to beat the market. If you can't commit the time and effort, there is no point trying to do something you can't succeed at. Fortunately, by choosing to admit that you are defective investors, you don't preclude the possibility of good result. Once you renounce attempting of pick specific stocks and trying to beat the market, you can own all the stocks and match the market. Index fund can practically everything in the benchmark like S&P 500, MSCI, all country world index. Though them you can own all the stocks all the time. The winner grow and the losers fade. You never need to trade because the index funds cost almost nothing to run. The lower expenses mean nearly all the market return flows through you. That is, in return, means they outperform most investors who incur high trading and research expenses.
Over time, index funds tend to earn high returns than at least two-thirds of the professional investors. Graham himself was one of the earliest advocates of indexation. And a defective investor is one who buys an index fund, hold it for the rest of your life, and almost never need to make another significant investment decisions. Even better, you could rest assured that the long run you'll be better than most professionals at the fraction of cost and aggravation. Regaining your balance. As a defective investor, you need yet another weapon in your arsenal. Buy low, sell high. There are one of the most basic principle of investing, but even if you own your own index fund, you still might end up doing opposite, buying high and selling low. The way of human brain work. Buying high and selling low feel natural and necessary, while buying low and selling high feel frightening and wrong. Buying high may be thrill experience expenditure, especially when you are on the hot streak. If a market flips on you and the selling low often feel like the only way to stop your wealth from being sucked into black hole of losses. When we invest, our neural circuit automatically makes some harmful action easier than beneficial behavior. To guard against the cycle of performance chasing, Graham suggests a simple rule: never have less than 25% or more than 70% of your assets in stocks. That also means you should never have more than 70% or less than 25% bonds. You should hold more in stocks when they appear cheap but historical standards, and less when seem expensive. Most of the time, you should favor 50% standard division between stocks and bonds. Because I explained the commentary on chapter 3, you can never be certain that the stock market is overvalued, undervalued. The Graham rule prevents you from even talking an overall nothing approach. And the stocks have doubled and tripled, and you might be tempted to put all your money to them because you are sure they are going up and even more. This rule still requires you to stop at 75% just in case you are wrong. And even when the market is crashing and seem to be heading to oblivion, Graham rules still won't permit you to go below 25% of stock just in case you are wrong. Today, equivalent Graham policies are replacing a procedure that set a target proportion of your total asset to keep in stock. Once a year after such a big rise and fall of stock market, rest of your holdings back to your target by selling some of whichever asset has gone up the most and buying some of the whichever has gone down the most. Adjust enough to restore your target percentage. The best place to rebalance is your retirement account, when where sales won't trigger immediate tax consequences. For simplicity's sake, let's assume your asset consists of two broadly diversified economic trade index funds on holding stocks and other holding bonds. If your investment policy, you are set your target allocation and half a stock, half in bonds, and if the stocks falls 20% and bond gains say 20%. Here what rebalance could look like. Rather than economically buying high and selling low, you automatically buy low and selling high. And when you making the market your servant instead of your master. After all, the ultimate goal of being defective investor isn't freedom of effort. It isn't freedom of worry. Rebalancing act.
Original balance 5,000, change in by 20%, new balance 4,000. Action need to be rebalanced by 1,000, resulting 5,000. Bonds 5,000, change in by 20%, new balance 6,000, sell $1,000 and resulting 5,000.